Thank you everyone that's joined so far. I'm just going to give it one more minute to allow people to come through from the waiting room and then I'll begin. Okay, now I think it's a good time to start. Hello everyone and welcome to today's masterclass. My name is Louisa Gaynor and I'm a Senior Client Advisor here at Netwealth. And as you can see, I'm joined today by Gary Horn, who's one of our Chartered Financial Planners. And today we're going to be answering your questions around thinking about how to maximize your retirement income. And I just wanted to start things off by thanking all of you who submitted questions prior to the webinar. These were really helpful in terms of steering the points we wanted to cover today. And you'll see that there is a Netwealth participant attendee on today's session as well. So if you have any questions as we go along, please feel free to address these to them or equally just put them in the chat box as well. And we'll do our best to cover them at the end of the session. If, however, you'd prefer to have your specific circumstances or your questions answered directly, then I would really recommend you sign up for our one-to-one follow-up sessions. These will be led by a member of our advisory team. There was an option to sign up for them at the beginning when you registered for the event, and we've already had quite a large number booked in, which is great. But the team here will recirculate the invite at various points throughout today's session, and then also after the masterclass. So if you haven't already done so, we'd really recommend you do that, and then we can discuss your personal details in more detail. And then in terms of what we're going to look at today, we know that retirement planning is an important and incredibly complicated topic. So first of all, we thought we'd talk through the key areas we need to recognise when considering our retirement plans. Then we can think about how to invest for drawdown, building out that robust investment framework within our retirement assets in order to generate those superior risk-adjusted returns through time. We're also going to look at the elements of retirement planning that we can't control, but that we can model for. So that's market performance, inflation, and longevity. And Gary's going to cover some of the important planning points about what we should be thoughtful about within our drawdown strategy, as well as understanding the changes to the LTA rules and how that may actually impact our retirement plans. If we have time, I'm also going to hopefully provide a quick demo of our online tools. These are free to use and really helpful in terms of enabling you to visualize your plans, track your wealth, and monitor them both through time. And hopefully throughout the session, what you'll see is that the Netwealth team, in terms of our people, as well as our online tools, can really help you to achieve your retirement objectives and put an effective plan in place. And so what I wanted to start with today was this slide here. And I wanted to talk about recognizing the elements of investing that we can't control and also optimizing those that we can. So there are many things that are out of an investor's control, and these are shown on the left-hand side of the chart here. There are elements of investing that, although we can't control them, we can model for them in our retirement plans. And it's incredibly important that we do so in order to get a good and a realistic indication as to whether our retirement goals are actually achievable. So the first one we can see here is market performance. Clearly, that's something that's out of our control. No one knows what returns are going to be over the next week, month, or year. However, by understanding how different asset classes tend to perform through time, there are things we can do to manage the volatility and the risk within our portfolios. And I'm going to come on to this in a bit more detail in a moment. The next one on the list here we can see is inflation. And this is, of course, something that we can't control. And it's something that we're experiencing at the moment, and we can see in real time how it can have a real impact on the value of our capital. So it is very important to factor into our plans, particularly if you're planning to withdraw cash flows from your portfolios through time. Factoring in inflation is going to be a big part of making sure that you have a sustainable asset base to meet all of your withdrawal requirements. And then the last one on the left-hand side here is longevity. And of course, people could never really be quite sure how long they're going to live. We all hope to live long, happy lives. But the message here is just to make sure that we're planning for living a little bit longer than we might otherwise expect. The risk here being that you outlive your assets. So it's important to plan accordingly so that just doesn't happen. And then now if we look at the right-hand side of the chart, and what we can see here are the factors that are very much within our control. And therefore, because they're within our control, we should be aware of them and we should do whatever we can to optimize them. And the first one here is time in the market and not timing the market. And this is just really trying to convey that we would never advocate for attempting to time the market. So not trying to feel that you can correctly decide when markets are going to drop or when they're going to start rising again, because history has shown how hard it is for anyone to do that. We saw markets drop quite significantly over the course of 2022 and into last year. And if we think honestly and we ask ourselves, who here was sitting in cash that would have had the confidence to get invested at a time when you would have been buying in at a lower price point? So you would have really benefited from that then rally that we saw towards the tail end of last year and into the beginning of this year. A lot of people I know missed out on that recovery that we saw recently and actually ended up buying back in at a higher price point, which just goes to show that you cannot try and time the market. It's very hard to do emotionally. The best thing to do is to think much more carefully about the appropriate level of risk that you feel comfortable with, making sure that over the long run, you are going to be there to harvest those market returns as and when they occur. And the next one on the list here is diversification. And I'm going to come on to this in a bit more detail when we talk about our investment approach. But broadly speaking, this is simply making sure that you're exposed to different asset classes that have different drivers of risk and return. Thinking carefully about the right way to populate portfolios and how to manage them through different economic cycles and market environments, to make sure that you're not overly exposed to investment factors, to a particular sector or region that may perform poorly at a particular point in time. And then these latter two at the bottom right hand side of the chart here, they're more to do with the financial planning element of investing and actually very little to do with the actual investment strategy itself. One of the very important things we think is how we structure our underlying investments. So being thoughtful about using our tax allowances and our wrappers each year. So that's the pensions, the ISAs, and also being thoughtful about how we're drawing on those in a tax efficient manner. And Gary's going to come on to that in a bit of detail in a moment, because I know we've had a couple of questions through about those points, because these can really help drive better net returns in the long run. And the other important factor here is about fees, because that, of course, as well has a big impact on your net take-home returns. And at Netwealth, it's a big part of what we focus on. We understand the importance of keeping the whole cost to clients really down to a minimum. So that's looking at the full picture. So not just our fees, but the underlying investment costs and some of those implicit charges that you may not be aware of, but that you are certainly incurring. Things like the bid offer spread that can be driven up if you overtrade, things like the ongoing charges figure that can be quite expensive if you're invested in active fund managers. It's really important to think about all these costs and to try and keep them as low as possible, because that will make a really big difference to your investment assets in the long run. And then another key area that I just wanted to consider as well is how we approach retirement, because there are a number of options available to us when we access our pensions. And this graphic on the screen here looks at the pros and cons of the two main options that people have when they get to retirement age. So that's really namely purchasing an annuity or going into flexi-access drawdown. And sometimes people choose to use a combination of the two. So on the left-hand side here, we're looking at some of the benefits and the drawbacks of an annuity purchase. And when we're talking about an annuity purchase, we're referring to giving up the value of your pension, and you give that up to a life insurance company. And typically they then pay you a guaranteed income for the remainder of your life. So the attraction of that, of course, is that it's guaranteed. So you don't need to be concerned with managing the portfolio. There's no risk of markets underperforming, or if you live too long. And if you have an inflation-linked policy, it mitigates that risk there as well. However, it is important to bear in mind that although annuity rates have absolutely risen over the last 24 months, they are still recovering from historically low levels. And the rates you may be offered may still not be able to provide a sufficient income to meet your needs. It is often a trade-off between a higher income now or an inflation linking policy. And whilst inflation is high at the moment, we wouldn't expect it to remain this high or at this level over the coming years, and certainly not for the course of your retirement. The other important point here, of course, is that an annuity has no value on death. So if you're taking out an annuity and you pass away quite soon afterwards, having given up your pension, then there is nothing to pay to your beneficiaries. So that's certainly something to consider if estate planning and passing on wealth is a priority of yours. So with flexi-access drawdown, which is on the right-hand side here, this is really the main alternative, and it's definitely more commonly used these days, and that is largely because of the probability that you will get a higher initial income. You do take on market risk and you have the risk of inflation, but it does mean you are generally spending more money. It is also an improved estate planning vehicle because the value on death can be passed on to your beneficiaries and there is no inheritance tax. The pension falls outside of your estate and so will not be held up by probate or subject to the potential 40% inheritance tax charge. And of course, it's flexible. So if you want more or less income, you can do that at your will. Clients often have fluctuating income requirements throughout their retirement, and so they can manage this quite comfortably through flexi-access drawdown. Whereas with an annuity, that amount will be fixed. So it could be seen as less efficient if you have a lower requirement for cash and the funds are being taxed and building up your taxable estate. As with an annuity purchase, however, there are also, of course, points to consider. The first here being the lifetime allowance. And as Gary is going to talk through the changes around these rules in more detail and later on in the session, and whilst as I'm sure many of you know that under the current rules and with effect from 6th of April this year, the LTA has actually been abolished completely. There is, of course, that underlying risk that under a new government, some variation of the legislation could be brought back. And so we can only plan on the rules as they currently are, but it is, of course, something to be mindful of. There is also the additional investment risk, as well as the risk of inflation and longevity, and we've already spoken a bit about these today. So there are, what we can see from this page here, a number of options, and we do tend to see most people opting for flexi-access drawdown, but that should be weighed up, and for particularly with those that have a low tolerance to risk, it may well be that an annuity purchase or a combination of the two is the right way for you to proceed. And so what we focus on here at Netwealth is actually the flexi-access drawdown element of your pension assets. So that's really investing pension fund assets through your retirement, monitoring the investment strategy through time, and making any adjustments where required. And so to begin with that, I just wanted to talk a little bit about recognizing the importance of investing for drawdown. And so what I thought I'd look at here is the thought about holding cash. So this chart here tracks the movement of the Bank of England base rate going back from 1990 all the way across to today, or to kind of halfway through 2024, where we are now. And what we can see on the right-hand side of the chart is that interest rates have increased significantly in the past 2 years, and they're currently at a rate of 5.25%. And I think the point to note here is that although we are currently seeing higher levels of return for holding cash, certainly than we have done so in recent years, and absolutely since the financial crisis of 2008, interest rates actually, in the context of going beyond this, remain lower than their pre-2008 levels. And crucially, we do not expect them to remain at their current levels for an extended period of time. Markets have actually already factored in that there are going to be at least 2 cuts later this year. So whilst we are seeing some reward for holding cash at the moment, this is unlikely to continue, and certainly not through the course of your retirement. So if the time horizon of our capital extends beyond 2 years, which it does for retirement assets, in order to keep pace with inflation, we need to think about an alternative to holding cash. And that alternative is often seen as investing. And I think the point is highlighted even more clearly here with this chart, which is trying to represent the effects of inflation over time. So what we're looking at here is the 16-year period to the end of 2023. And the reason why we've focused on this time frame is that we wanted to take it back to the beginning of 2007, so before the financial crisis. So here we're showing a portfolio of 100k. And what happens to that portfolio if it's left in cash, which we can see in the dark blue line, or if it's invested in line with our Netwealth risk level 4 portfolio, which is in that lighter blue line. So both lines are looking at the real returns, which means it's after the effects of inflation. And if we look at the dark blue line first, so that's the cash portfolio, you can see that actually at the beginning of the chart, when interest rates were slightly higher, so prior to 2008, you were actually getting a small positive return on the portfolio. However, if we follow that line across to the right of the chart, we can see that after 16 years, that 100k has decreased in real terms to just under £66,000. And we can see that that decline is even more significant since the pandemic in 2020, when we saw inflation start to rise quite dramatically. So this really does show that while cash is safe and it is secure, and it will always play an important part in our overall asset allocation during retirement, we should consider carefully the level of our cash requirement. And if we look at the lighter blue line, so that's our balanced risk level 4 portfolio. So broadly speaking, that's a 50% split in equities and fixed income. And if we follow that line through, we can see that by having the portfolio invested, you are absolutely taking on some risk. And during the financial crisis of 2008, you would have experienced the portfolio fall in value as markets came under stress. But if you remained invested for a long time, you actually allow the portfolio the ability to recover when markets recover. And in this case, by the end of 2023, despite the market volatility we saw during that period, the portfolio has actually grown in real terms to just over £111,000. So what we're just trying to show here is that holding too much cash in the long run allows inflation to erode the real value of your capital. And in order to increase the life expectancy of your investment assets during retirement, it does make sense to invest. And whilst there is always a role for cash in our financial plans, and this is particularly true for those in retirement and investing for drawdown, it is just also important to ensure that we are holding the right amount of cash and as being as efficient as possible with our plans. And I just wanted to touch on for those looking to hold some cash, because we do offer some cash-like portfolios. So as I mentioned earlier, we do always recommend that clients hold an element of cash, and the amount of which you have will vary depending on what stage of life you're at. But quite often clients, they get concerned about credit risk. So that's really being protected by the Financial Services Compensation Scheme, which is up to £85,000 per person per banking organisation. And it may be that clients in their retirement want to hold more than that in cash, but don't want to hold it across a number of different bank accounts. So this is where our risk level 1 portfolio, which is also known as our liquid reserves portfolio, can be quite a nice alternative to that. Our investment team, due to demand from clients and where we were in the market cycle, decided to remodel our risk level 1 portfolio a few years ago. And this was really designed to take advantage of the high interest rate environment. So as you can see on the left-hand side, it's predominantly made up of a low-risk money market fund and ultra short-term corporate bonds. And as you can see on the right-hand side, because of interest rates being where they are, this actually has a current estimated gross yield of 5.3% per annum. So you are seeing a bit of a nice return on that portfolio for taking on very, very little risk. So the theory behind this rebalance was really that we felt it could be quite a good alternative for client who wanted to make the most of this high interest rate environment, but wanted to steer away from market volatility. Perhaps they were parking some money aside for a big upcoming capital expenditure, maybe paying a tax liability, purchasing a property, house renovations, or they were just slightly nervous about entering a volatile market and so wanted to park the funds there before drip feeding them into a higher risk level. It's got a number of uses and would be very happy to talk to clients about that in these one-to-one follow-ups that we've got coming up after the session. I appreciate, however, that when it does come to investing, and once you've earmarked the element of your money that isn't appropriate for risk level 1 or for cash, and you know that it needs to be invested to stand the test of time, the actual process of getting invested can be a challenging one emotionally, particularly during a volatile market. However, one of the things we really lay emphasis on, and something that I've already touched on today, is just not attempting to try and time the market. It's impossible for anyone to know when is the right time to buy or sell and to time the market correctly. And I think this chart here illustrates this point quite nicely. So what we're looking at here is the S&P 500 US equity returns since 1987 to the end of 2023. And it shows that if you had simply invested and held and reinvested over that entire period, you would have made a return of 4,284%. But as you can see, it's not a smooth journey. There are periods where you would be losing money, and that's obviously quite concerning. But actually, broadly speaking, you're making money as markets trend up over time. But if you were trying to time the market and you missed the top 10 trading days over this very long period, this would have significantly impacted your overall return. And at the end of that same period, you would have only been up just over 1,800%. So this is really quite a large difference, and it really highlights the importance that it is very hard to know what is going to happen to markets in the short term. But what we do know in the long run is that you are generally expected to get rewarded for taking risk, albeit it may be a slightly bumpy journey. And I think this next chart here just serves as a good reminder of this. It's always really important to remember that when you're investing, markets can be volatile, but it shouldn't stop you from investing. So what we're looking at here is the FTSE All-Share Index, which is effectively the UK equity market. And we're looking at the time period between 1994 to the end of 2023. So what you're looking at in the grey bars are the total calendar year returns. That means where the FTSE All-Share ended the year from January to December. And what you're looking at in the blue bars are the biggest intra-year drawdown for that position over that year. And what we can see here is that even in years where there are positive returns at the end of the calendar year, there are still some periods within the year where you could have been facing quite significant intra-year drawdowns. And if we focus on the middle of the chart here, for example, so if we're looking, let's say, at the years from 2003 to 2013, you can really see that in some years, although the year ended positively, during the year there would have been quite significant drawdown. And if we take, let's say, an obvious one, so 2009, for example, in the middle of the chart, whilst the blue bar shows you that you would have experienced drawdowns of over 20% during the year, actually, by the end of the year, you are up around 30%, so a huge contrast. So looking at this chart, it's just really important to remember that there is always going to be some volatility and risk when you invest, especially over the short term. And you've got to make sure that you understand and are comfortable with taking on the risk with the aim of targeting the correlating level of return. And I think then this next chart here is quite a good way of visualizing it in terms of your retirement assets. So it's important to think about the different goals and the different time horizons that you have, and to marry these up with the levels of risk you're willing and able to take on. So this chart here demonstrates the importance of this. What we're looking at here are 3 of the 7 net wealth risk level portfolios, and we have simulated their past performance going back over the last 25 years to get an understanding of the risk embedded within each of these 3 portfolios. So the lower risk level 2, is shown in the dark blue bar. The balanced risk level 4, is in the grey bar. And the highest risk level, our risk level 7 portfolio, is in the lighter blue bar. And what we're looking at here is how the time horizon that you invest for, which is shown on the x-axis there, is really important when you think about the risk you can tolerate and are able to take on. So the chart shows the percentage of times that you would have expected to have lost money over the last 25 years from investing in one of these 3 risk level portfolios. So if we start on the left-hand side with a 1-month time horizon, which is obviously an incredibly short time horizon anyway, you can see that there is quite a high percentage of time in all 3 portfolios where you would have actually lost money. Although in all 3 cases, it's less than 50%, which means that more than 50% of the time you would have made money, it's still quite a high percentage to have lost money. And as we move across to the right of the chart, you can see that as the time horizon increases, so we've got 6 months, 1 year, 5 year, and then 10 years, the percentage of times that you would have lost money decreases. And for those lower risk portfolios, so risk level 2 in the dark blue, it decreases at a much faster rate than for the higher risk levels. So you can see that at risk level 7, there's still a probability, almost 10%, that you would be in a lost money space after 5 years. But after 10 years, based on the data of the last 25 years, the probability that you would have lost money in any of those 3 portfolios is saying it's 0. So often people think that because they're drawing on investment assets, they need to look at a very low level of risk, perhaps even cash. And whilst it's important to be comfortable with the risk level you take on or the combination of risk levels, and that's absolutely true, it's actually likely that if you're simply drawing a regular income from your investment assets, the bulk of your funds remain invested and your time horizon is actually very long, the length of your retirement, which can almost be 35 years. So as we can see from this chart here, with this time horizon, you can afford to take on a greater level of risk. And whilst you may not want to take on as much risk as you would do in risk level 7, you may want to forego the possibility of getting those higher returns in exchange for a greater level of consistency in the portfolio journey. You may also be comfortable taking on more risk than just a risk level 2. So it's certainly worth being thoughtful around your investment strategy. And as I mentioned earlier, then marrying this up with your time horizon and your goals for the investments. And this is something that we can talk about on a much more specific level in the one-to-one follow-up sessions. Because whilst all clients may have very similar retirement objectives, their wider circumstances will all be very different and unique. And so that's why it's important to focus this on an individual case-by-case basis. And this just leads me quite nicely on to thinking about where your retirement assets sit in your overall asset base, because their composition needs to strike the right balance between being invested, having those investment returns, and also holding down a degree of liquidity. Because when you move into that phase of life where you're drawing that regular income from your investment assets, liquidity matters. So having more cash on the side and thinking about your allocation between these three hypothetical pots is important. So pot one at the top is our cash pot. It's our very short-term and liquid pot. So it's typically going to be cash in an instant access bank account. It may be the income you receive from employment, rental income, perhaps those that are lucky enough to have DB pensions or are already in receipt of their state pension, things like that. And it's going to have outgoings as well, just to cover the cost of living on a daily basis. And during retirement, we would usually suggest that clients hold between 12 to 24 months worth of their annual outgoings in cash. This is likely to be more than they've done so historically, but the purpose of this is that they're then able to provide for any unforeseen circumstances or to draw on in times of market stress where their invested portfolios may be performing poorly. Rather than in drawing from those invested portfolios which have reduced in value, they can draw instead from the cash pot and allow the invested pot that time to recover with markets. And at the other end of the spectrum there, we can see we've got pot three at the bottom. And this is our much longer term investments that will typically be pretty illiquid. They may also be quite high cost and quite volatile, but often in the longer run, we would expect them to generate the most return. This is for most people usually assets such as property, but it could also take the shape of something less common. It can be private equity investments or even an investment in a friend's company. And now looking at pot two, which is the middle here, and this is what we focus on at Netwealth. And it really is the core of what a high quality wealth manager should provide when they're focusing on investing for drawdown. So pot two is for the medium to long term. It's designed to provide that stable core of diversified equity and bonds to our investments with the aim of simply beating inflation through time. And the key is really just understanding your relative mix between pot one, pot two, and pot three, and thinking about how you're allocated and whether you're being as efficient as possible. And now if we just focus on pot two, so those retirement assets, those pensions, those ISAs, perhaps a general investment account, and how we would manage them at Netwealth. So broadly speaking, Netwealth's investment approach is active asset allocation with passive implementation. And there are three components to this. The first and the biggest contribution to the risk being taken within portfolios and the returns being generated is our strategic asset allocation for each risk level. This represents our view on what the best mix of asset classes is for any given level of risk. If you were to invest in a portfolio, leave it there, not touched, come back in 20 years' time, this would be our best estimate of how you should be positioned over that time. In reality, however, we think it's really important to keep a view on how different asset classes are changing. And over on the right-hand side here, you can see how we think about the cyclical positioning of our portfolios. If we think there are given risks embedded in a strategic asset allocation for a portfolio, and we think we can mitigate those, then the investment team will act on this. Similarly, if they think there is an opportunity that can be taken, they may also make adjustments here. The aim and the intention is always to smooth the path of portfolio returns for clients. And we've briefly touched on the importance of keeping fees down and cost efficiency, and that's always at the forefront of our minds when investing. And a key part of that and how we deploy it is through our instrument selection in the middle here. We primarily use passive instruments, exchange-traded funds within our portfolio. And a driving factor behind that is not only their liquidity, their ability to deliver on desired exposures, but also their cost. We would rather take those market returns, build a diversified portfolio, and deliver a greater percentage of those market returns back to clients so that they can compound much, much faster. And this slide here just shows a snapshot of the asset mix as a whole. So here we're looking at our range of portfolios. So we've got risk level 1 across to risk level 7. And we can see how the dynamics change as we move up the risk return spectrum. So we can see that in the lower risk portfolios, the predominant exposure is to cash or cash-like assets and fixed income. And as we move across to the right-hand side, the equity mix increases and we reduce our exposure to bonds. And we think about currency separately as well. As we move up the risk spectrum, we can see us transitioning from a predominantly sterling-based portfolio to a much more diversified portfolio mix. And this is always done in a very thoughtful way. For example, at a strategic level, we've been pretty unsure as to whether the euro currency exposure would provide an added benefit to our portfolios. And so whilst we invest in European equities, we do it on a hedged basis. Whereas at the moment, we quite like the exposure that the US dollar brings, and similarly to an extent, the Japanese yen. So we've got exposure to both of those within our portfolio as well. And a couple of people before this webinar have asked questions about the relevance of bonds within our portfolios and whether there still is a place for the 60-40 portfolio for investors. And I think this chart here shows the value of holding bonds through time. So what we're looking at here is the performance of UK fixed income during periods of stress in the equity markets. And we're looking at the years 2004 to 2023. And in each bar, the area that is blue shows the biggest intra-year drawdown for equity markets, and the area that is grey shows the fixed income return during that drawdown period. So what we can see here is that generally speaking, during times when equity markets come under stress, the bond market tends to strengthen and therefore somewhat mutes the level of loss we would see in the overall portfolio. And this is particularly clear if we look at the centre of the chart and looking at the years from 2007 across to 2020. In 2021 and 2022, however, looking more towards the right-hand side of the chart, we did see pretty unprecedented moves in the bond and equity markets, which is what questioned the relationship of the 60-40 portfolio and its value. We saw the bond and equity markets relationship with one another change to a positive correlation environment. In 2022 specifically, and we can see it on this chart here, we saw both asset classes perform poorly, which had a significant impact on all portfolios across the board. This would, of course, been really uncomfortable for investors to experience. However, we do not believe that it negates the role of bonds in our portfolios. Because really what we've seen here and what we've already seen in this market is that the bond markets have actually reset and the relationship between the two asset classes is starting to right itself. And we can see in that final two bars of the chart here, that reflects the performance over the course of 2023, that their negative correlation has gone back. And when the equity markets came under stress, the bond market strengthened. So we do still believe in the concept of the 60-40 portfolio, and whilst it is constantly under review by our investment team here, we still believe that there is a place for bonds within our portfolios and our investment strategies. And now I'm just going to pass over to Gary, who's going to answer some of the questions that have come in around pension planning. So Gary, I'll pass over to you.
That was great. Thanks ever so much, Louisa. So what I'm going to be focusing on mainly today is the area around pensions. So as Louisa had mentioned earlier on in the session, is using tax allowances, one of the controllables we have within our power, using the available allowances tax allowances is really important. So first of all, I'm just going to sort of mention why pensions and why they're still important. Well, first of all, pensions are likely to always remain an important element of our sort of retirement saving portfolio. The reason being is when you make pension contributions, you get tax relief at your marginal rate. So that's obviously highly effective in that regard. And also pensions are outside of your estate for IHT purposes. So that is also important for many people as well. So first of all, I'm going to just recap on the rules in terms of what they were, the changes that took place last year as a result of the spring budget and now have come into play from the start of this tax year as well. So in the spring budget last year, most of the changes which took place were favourable to savers. So firstly, if you don't know, we each have a maximum annual allowance that we can save into pensions. So that was actually increased from 40,000 a year to 60,000. That was increased from the start of the 6th of April 2023. Furthermore, the money purchase annual allowance was increased. So this is for someone that has already accessed their pension by taking an income. So previously, let's say if they'd sort of been in work gone out of the market and therefore needs to take some income, if they re-entered the labour market and wish to then start contributing again, that they would be subject to the money purchase annual allowance. So that actually increased from 4,000 to 10,000. So again, favourable in that regard. I've mentioned that the annual allowance for a standard individual is now £60,000. There is also something which is relevant for high earners, and that is the tapering of the annual allowance. And that actually, that point where that started, the annual allowance started tapering, has been increased from 240,000 of adjusted income to 260,000. So again, that's a benefit. And also, in terms of where the fully tapered annual allowance kicks in, that's for someone that has earnings above or adjusted income above 360,000, such that the fully tapered annual allowance is now 10,000. That's an increase from 4,000. So all of those rules around the ability to make pension contributions has all been favourable. Now, the other key component, which I'm sure you may be aware of, is around the lifetime allowance. So the spring budget last year, from the start of last tax year, immediately made the LTA, the lifetime allowance tax charge, zero. Now, the reason why that was done is because in order to get rid of the LTA altogether, that was going to need some writing out of legislation, and that's actually what has happened now. So from the start of this tax year, the LTA does not exist anymore. So, and I'm going to come on to that a bit in a short while in terms of the implications for that and potential planning opportunities. What does still exist, though, from this tax year is the maximum tax-free cash that someone can take at retirement. So, generally speaking, when someone goes to access their pension, they're able to take 25% as a tax-free lump sum, but that is now fixed. The maximum they can take across over their lifetime is fixed at 268,275. That's for someone that has no form of protection for their pension, so with any form of fixed protection. So if it's not obvious, it is actually 25% of what was the prevailing lifetime allowance, so 1,073,100. But the LTA doesn't exist anymore. It's the maximum tax-free cash, that lump sum. That's the relevant point. What are the relevant aspects in terms of for clients who are still saving? Well, clearly someone who has not accumulated a pension pot above that a million mark, they can still continue contributing and therefore ensure they're maxing out the available tax-free cash they can take at the point they do wish to access their pension. So that's a bit of a quick recap of the rules, the changes that took place, and where we're at now. Now, the only thing we don't know, if it's not obvious, is in terms of in the immediate aftermath of the spring budget last year, Labour said they'd essentially reinstate all of the changes which were made. Now, since then, there's been sort of little word from what any future Labour government may do, assuming they do come into power. And with that regard, any changes they do make may be not necessarily just reinstating the LTA, and it could be something entirely different. Now, as an advisory team, we're obviously closely watching the developments and advising clients as and when they need advice on those relevant points. So first of all, I'm just going to be looking at the implications regarding the changes of the LTA. So yes, first of all, the key aspects for someone that is below the lifetime allowance. So as already mentioned, most of these were favourable. People can now contribute more to their pensions with the annual allowance increased. So there's a greater opportunity for individuals accumulating wealth within their pensions. And in addition, as mentioned previously, for high earners, so I'm talking about people with earnings above that 260, where the tapering of the annual allowance comes into play, they can now contribute a little bit more As much as it's not huge, as we are restricted as UK investors, it's really important that we do take advantage of those allowances which are available to us. So in terms of pension contributions, what's the current state of play? So as mentioned, the annual allowance is now 60,000 a year, the standard annual allowance. So an individual can contribute up to that amount, assuming they have the relevant earnings to support that. In addition, it's worth noting for those individuals that have capital and the ability to make larger pension contributions, you can in fact carry forward annual allowances from 3 tax years back. The way it works is you pay a pension contribution. Your current annual allowance annual allowance is used first, and then the one from 3 tax years back is used first, and the buckets are filled up in that order. So pension contributions can be hugely beneficial to taxpayers, and in particular for high rate taxpayers and additional rate taxpayers who will get maximum marginal rate tax relief. I've mentioned that these are the annual allowances, but it's just important to note that even if you've got the available allowances, you are still restricted in terms of what you can make in a given tax year by your relevant earnings, in terms of the ability to get tax relief on those pension contributions. And broadly speaking, that is your earned income. So whether it be salary, any bonus, or any profits if you're a sole trader. So just a quick example on that to bring that into play. So if you're a basic rate taxpayer, you made a pension contribution of 30,000 gross. The way it works is you make personal pension contributions net of 20% tax. So in this case, a 30,000 pension contribution you would fund with a 24,000 pound contribution. That 20% basic rate tax relief then automatically gets reclaimed by the pension provider and then credited to the pension in a few weeks by HMRC. If someone was in the position to make a contribution of 100,000, they'd obviously fund that net of 20% tax, and that would be an 80,000 contribution. Again, the 20% would get credited, the basic rate tax. The higher or additional rate tax would then be reclaimed through the self-assessment tax return. Clearly, in this scenario, if someone was making a contribution of 100,000, that is above the standard annual allowance of 60,000. So this would require having sufficient unused annual allowances from the 3 tax years back. And these are the sort of things we can help clients calculate if they're unsure, if they've, for example, had variable earnings and they're not sure of their position. In terms of the tapering, I've already sort of touched on in terms of high earners. Some people may be subject to the tapering of the annual allowance. That now kicks in where your adjusted income is above 260, such that it's reduced by £1 for every £2 above that, with the maximum reduction of 50,000 from the standard annual allowance. So therefore, with a standard annual allowance of 60,000, that would bring down the fully tapered annual allowance to 10,000. Now, tapering was brought in from 2016-17. This was very much targeted on, I guess, limiting the amount of tax relief it was costing the government, and in terms of funding higher and additional rate taxpayers. That's the sort of backdrop for it. And in terms of adjusted income, as a reminder, it's not just earned income that comes into play here. The main aspects are earned income, other taxable income, and also one key aspect is it also needs to be added back in employer pension contributions. But again, this is quite a complex area, and if you're sort of not all over the rules, these are the sort of things we can help as an advisory team with your planning. So looking at the changes for those that are now at or above the lifetime allowance. Now, the reason why I put it in inverted commas, because obviously the LTA has been abolished. But what is still relevant is the underpinning of the tax-free cash, which is effectively the accumulation of your pension pot around that 1,073,100 mark, such that you've maxed out your tax-free cash. So with the LTA now gone, that obviously provides more opportunities. You're no longer going to be penalised by an LTA tax charge. You've got the ability to accumulate more because the allowances have been increased. Contributions will continue to get the tax-free growth within the pension, so a very beneficial way of accumulating savings. As Louisa mentioned earlier on in the session, the pensions remain outside of the estate for IHT purposes, so a very good vehicle if you're using that for passing on wealth. And again, the LTA tax charge no longer exists, or the LTA doesn't exist. So looking on now for situations where you're close to the lifetime allowance and what that means for individuals. So and those for above the LTA. So essentially, clearly in this particular type of scenario, if your pension's already above that 1 million mark, contributing further is not going to increase your tax-free cash. Now, we've had quite a few questions and queries from clients over the last year around planning opportunities around the LTA. Now, it really just depends on the actual client situation. Clearly, one could maybe take sort of action around the LTA, crystallising their benefits so that they've fully crystallised in a regime, let's say, where the lifetime allowance doesn't exist. But it really just depends on the situation and what you, for example, will therefore do with the tax-free cash you take out from the pension. So I guess what I'm sort of saying is it's all well and good trying to take action to mitigate against any future potential changes in legislation, for example, bringing back of the lifetime allowance. But clearly in that scenario, if you're bringing in the tax-free cash back into your estate for IHT purposes, that's ultimately going to be taxed at 40%. So just to try and avoid some potential LTA that may or may not happen. So it's really just thinking about your overall situation, and these are the type of considerations we can help as an advisory team. So just moving on now, for those that are already above the LTA. So similarly to those that are at the LTA, we've had questions about whether they should crystallize. So I think it's just being really thoughtful around your overall situation. So absolutely, it's possible to, for example, crystallize when there's no LTA. So therefore you wouldn't incur the LTA tax charge any longer. There's no LTA tax charge at age 75, which there was previously. The main thing being, though, is that you are limited to that maximum tax-free cash over your lifetime. So again, contributing if your pension's above the LTA can still be beneficial, even if you've maxed out your tax-free cash. The reasons being is because it might be that you're not actually going to use your pension for your own purposes during your lifetimes. The pension's outside of your, and therefore the pension's outside of your estate for IHT purposes. So it's just an estate planning vehicle. You continue to get tax relief on pension contributions when you pay in. So it might be that you're a higher or an additional rate taxpayer when paying in, but actually in retirement you can manage your situation such that you only pay basic rate tax. So regardless of the fact that you may not be getting more tax-free cash, by pensions can still be hugely beneficial for those individuals. It just really depends on your overall situation. Okay, so I'm just going to now look at sort of a situation where someone's actually gone into drawdown, and this is really just picking up on something that Louisa had mentioned earlier. So in this particular scenario, this client is now in drawdown. They're now accessing their portfolio. They're drawing £18,000 per year to meet their retirement needs. And this is really just demonstrating, and this is particularly poignant how, because we've had more and more questions around, should I just be holding cash now with yields on cash or returns on cash, providing something now. In this particular scenario, very similar to the graph which Louisa provided earlier on the session, that we've purposely chosen here where we've just started the projection just before the financial crisis when markets crash. So what we've got here is in the navy line is the return on cash. Now this is the real return, so it's after inflation. And in the grey line, we've got the risk level, Netwealth risk level 4 portfolio. So this is a balanced portfolio, broadly a mixture of 50-50 mixture of equities and bonds. The main point really just to sort of demonstrate from this particular graph is absolutely in this first part of the first few years, you can see that you'd have been benefiting by just holding cash. Clearly markets fell as a result of the financial crisis, and you can see the risk level for portfolio fell accordingly. But what we've got here is the blue shaded area at the bottom is showing the additional value from being invested over the period in time. So now, the main relevance here is, as Louisa had mentioned earlier on in the session, it's very difficult to actually time markets. No one knew that financial crisis was happened. Similarly, the pandemic was a random event, so it's really difficult to actually know when it's coming. But what is absolutely key is if you had been invested throughout the duration of this period, so it's now run up to the end of 2023, you can see from the grey line that the risk level 4 portfolio would have had still 80,000 remaining at the end of the projection, so still many years of drawdown available, whereas the cash would have depleted by the end of December 2022. So that's really just giving you a quick example of we've mentioned the controlling the controllables. Certainly trying to time the market is difficult, but absolutely what is key is being invested in the right manner to meet your objectives over the course of your lifetime, and that's something we can help with. Now, just to give you a very quick example in terms of retirement drawdown strategies and how this can improve and enhance your situation. So what we've got here is a case study. Annabelle is age 65. She's just retired. She's got a pension pot of £1 million. Okay. So she takes her maximum tax-free cash of 25%. She reinvests that into a general investment account, and then she funds her ISA allowances each year from the GIA. She then invests her pension portfolio and the GIA and the ISA into a Netwealth risk level 5 portfolio. So that's a sort of slightly moderate to high risk level, around 60% in equities. Her objectives are to meet her needs over the course of her lifetime. So that's essentially a net income target requirement of £3,500 per month. Her secondary objective is then passing on wealth to her 3 children. So the first projection I'm just going to look at is just one particular drawdown strategy which Annabelle could have adopted. So the first one is she's going to just be taking that income from her pension. She's going to be drawing out down that. So it's quite a common thought that pensions should be the first place to be meeting these, but that's not necessarily the most tax efficient. So what we've got here in this projection, it's running to age 95. So we generally run our projections as a prudent scenario to ensure the client's needs can be met throughout their lifetime. What we have here is, if we focus on the white line, which is the average growth scenario, is what we can see here is Annabelle does meet her objectives at age 95. You can see there's £330,000 worth left on the balance sheet in her wealth. So she's met her needs and she's got wealth to pass on to her children. In this scenario, that 330,000 is now just remaining in her ISA portfolio. So she's depleted the pensions, she's depleted the general investment account by funding the ISA allowances, and she's just left with that wealth in the ISA. So that's great. She's met her objectives. But I'm now going to look at an alternative wealth projection where just demonstrating how being a bit more tax efficient with the way a client can look at things, how it can improve the scenario. So what we've got here is Annabelle, all the same assumptions in terms of how she's invested, same fees, but in this particular scenario, rather than meeting her needs wholly from the pension, she's now going to only take pension income by an amount which uses her basic rate bands. Now, that can quite commonly be the right strategy for clients. And the reason for that is what you could find is if we can model and it seems like a client is actually going to need to use their pension in their lifetime, it can often make sense to be using a basic rate band in order to mitigate the scenario where you've depleted the general investment account and the ISA, such that you're left with just the pension to meet needs, and then you would otherwise be paying more high rate tax later on in life when you've not been using your basic rate band in the intervening years. So in this particular scenario, what we can see is at the end of the projection, Annabelle has, rather than the 330,000 left at the end, she's now got 655,000 left. So that's great. And in addition to that, rather than the wealth being just within the ISA, it's actually within the pension. So, and as I've already mentioned, the pension is outside of the estate for IHT purposes. So just a small change here can have quite huge implications for improving the client's position. So there's that, and then the next projection is just to quickly show you the impact on fees. So one of the controllables that Louise has mentioned is our focus at Netwealth on keeping fees low. So this wealth projection is exactly the same as the one before, but just showing the impact of just a 1% increase in fees. So what we've got here is demonstrating basically just 1% increase in fees, how the wealth under the average growth scenario, so that's that middle white line, actually depletes by around 2056. So it's 4 years earlier than what would otherwise have been purely just by paying less in fees, which is why it's such a key component for clients and investors, and that's why we very much focus on keeping costs low for clients. So there's that. Thanks for that, Louisa. So Louisa is now just going to quickly take you through some of our online planning tools.
Thanks, Gary. Yeah, so I thought I would just close out this session by having a look at some of our online tools. These tools are available for anyone who registers with us, so there's no requirement to be a client. You can register in a link that's hopefully being circulated in the chat box right now. And it's just a great way of being able to not only track your wealth, but then also kind of think about and visualize your financial plans through time. And certainly if you have a go at these tools, part of what our one-to-one follow-up session can cover is going through them together. We can answer any questions you have and also have a look at refining the plan with you. But I just wanted to give you a bit of a basic tour of the website now so that you're familiar with it if you do choose to go ahead with that. So you can see here that I'm logged into a demo account, and as you get to the home page, there's a whole array of information that's available to you. We've got webinars, so today's one is likely to be put up there, articles, information about Netwealth. We've got information around our guidance offering here. So it's really worth having an explore around. But the two things I just wanted to show you today were our wealth tracking and planning tools. So if I start with the wealth tracking tool, what this effectively does is it enables you to get a better oversight of your investment assets, whether it be an allocation to an investment, to ISAs, pensions, cash. You can upload the details of each account that you have onto this page here. So you can then see your overall split across the different asset classes, as well as your split across the different account types. And you can track the performance of the portfolios through time. So you can see here that this demo client has Netwealth portfolios, and so the information from these have automatically pulled across. But then she has accounts outside of Netwealth, which she's also uploaded the details of. And you can see here that she has then also included exactly what position she holds within the portfolios. So within this particular account that I've clicked into, she has 2 funds and a stock position, and she's uploaded these here. And these will now track from this point onwards the day-to-day performance of these positions so that it can give you the live data for your portfolios and you can see the value of them through time and whenever you'd like to. So it's just quite a useful thing for clients to have when they have a number of their investments spread across a number of different providers. But the other key point that I really wanted to show you today, which is particularly relevant to talking about retirement income, is our wealth planning application. So again, this has been pre-filled with the information of our demo client, and it's created a projection based on the data that we've input there. So if I just show you what we have with this particular client, she's 53, she's still working, she earns a current salary of £110,000, and her current retirement date is set to 65. So that can be adjusted based on whether you think the goal is achievable. She would like in her retirement to target just from her investment assets £5,000 per month, and will inflate that by 2.3% per annum to account for inflation. She'd also like to factor in a number of large one-off withdrawals. So she intends to make a gift, it may be to a child. She wants a large holiday and also paying off or buying a new car. So those are things that she needs to think about, because overall £375,000 is going to be removed from her overall capital that she's going to use to fund her retirement. So those are her goals, and those can be amended based on what we think is achievable. And then here she has the option to upload the details of her pension. So the pension will have pulled through again from the tracking tool that we have. So that's great. That should do all the heavy lifting for you. And you can select which level of risk you think your pension is most likely akin to. So if it's not with Netwealth, but you know it has between 70 and 90% in equities, that's when maybe you choose the risk level 6 of 9 on the spectrum. You can also add in here your state pension and any defined benefit pensions that you have. So if, for example, you know you're going to receive your full state pension, you can add that in here, and that will then alleviate some of the pressure on your investment assets to meet that income requirement. So it's really important to factor that into your overall plan, because it definitely has an impact on the longevity of your assets. We've also got the ability to put in your ISAs and also your general investment accounts. That's probably where I'd recommend putting in any cash positions that you have as well. And once you're happy with your inputs, you can then run the projection and have a look at whether it's saying you're able to meet your goals. Our projections try to run to the age of 95, because as Gary's already mentioned, that's really where we feel is beyond the average life expectancy, and so slightly mitigates that risk of outliving your investment assets. And it highlights here the key points of your retirement. So we've got here 65 when this client intends to retire. Here we've got the various one-off withdrawals that the client is making. And of course here we've got age 95 at the end of the projection. And we can see here that we're on track to achieve our goal, which is great. But were I to shift one of these variables, perhaps significantly reduce my retirement age or significantly increase my retirement income, it would have a big impact on this projection and whether I was able to achieve my goals. And so those are the things that you can play around with to see what you actually think is achievable. I'm conscious of time now, so I'm actually going to just switch back to our presentation, as I just wanted to close by just providing an overview of how we can hopefully help you here at Netwealth. So really, to provide a kind of summary almost of what we do here, I just thought it would be useful to give a bit of background as to Netwealth as a company. We were founded in 2016, and we were really founded with the aim of bringing modern technology alongside the best bits of traditional wealth management, with the aim of delivering a service that was fit for today and available to many more clients. And we understand that there can be no replacement for people and for their expertise, and this still remains at the very heart of what we do. So we have a team of expert investment managers that manage our portfolios, and we have a team of experienced client advisors who are able to manage the investment offering that is provided to clients and are able to talk to them whenever they would like to speak through their plans. But where we would really differentiate ourselves is with our powerful technology, and I've shown you a bit of that just there. And that's designed not at all to replace our people, but just to enhance the client experience by delivering a greater degree of transparency and accessibility for clients in terms of understanding their investments and also being able to monitor these through time. The use of our technology also enables us to deliver our service at a much lower cost and with no compromise on the quality of it. And I think this can really be seen in our track record, the consistent support of our leadership team and our shareholders, and it's something that hopefully we can provide much more detail to you in our one-to-one follow-up sessions. I think it's probably a good idea to close here just because I appreciate that we are slightly over time. But if you have any questions, please do feel free to email those across to us at advice@netwealth.com, or do sign up to the one-to-one follow-ups where we can talk through your specific circumstances, answer any questions you have around the investment approach, the advice offering, and the relevant costs as well. Gary, is there anything you wanted to add before I close for the day?
No, that's great. Thanks very much, Louisa.
Perfect. Well, thank you very much, everyone, for attending. We'd be very grateful for any feedback you have. And equally, we hope to be able to get back to you on any questions in the follow-up sessions. But thank you, and everyone enjoy the rest of your days.